We will meet any Trump tariffs dollar for dollar, and we will retaliate to the tune of about $155 billion in aggregate.
For decades, Canada's auto industry has been closely tied to the U.S., but that relationship is now under serious strain. After the U.S. hit Canadian auto imports with a hefty 25% tariff in early 2025, Canada fired back with a massive $155 billion retaliatory package. And that's just the beginning. With tensions escalating, Canada is now looking beyond its traditional trading partner and setting its sights on Europe. Could this be the start of a permanent trade shift? And what does it mean for automakers like Tesla, now facing the threat of a 100% Canadian tariff? Let's break it all down. The recent imposition of a 100% tariff by the United States on Canadian automobiles has sent shockwaves through the North American automotive industry, with significant repercussions for manufacturers, supply chains, and consumers alike. One of the most immediate impacts is the disruption of the deeply integrated supply chains that have been the backbone of North American auto manufacturing for decades. Major automakers such as Ford, GM, and Stellantis rely heavily on the seamless flow of parts and vehicles across the US-Canada border. The new tariffs threaten this synergy, potentially leading to production slowdowns and increased operational costs as companies scramble to adjust their logistics and sourcing strategies. For consumers, these disruptions are likely to translate into higher vehicle prices. The added costs incurred by manufacturers due to tariffs and supply chain adjustments are often passed down to buyers, making both conventional and electric vehicles more expensive. This price hike could dampen demand, particularly in the EV market, where affordability is a critical factor for consumers considering the switch from traditional combustion engines. Tesla, a prominent player in the EV sector, finds itself particularly vulnerable in this scenario. The company sources essential minerals like lithium and nickel from Canada for its battery production. With the new tariffs in place, Tesla faces increased production costs, which may lead to higher prices for consumers and potential delays in EV adoption. Moreover, the stock market has reacted to these developments, with Tesla's share price experiencing volatility as investors assess the long-term implications of the tariffs on the company's profitability and growth prospects. The broader EV industry is also at risk. As production costs rise due to tariffs and supply chain disruptions, manufacturers may be forced to delay or scale back their EV initiatives. This slowdown could hinder the overall progress of EV adoption in the U.S., affecting environmental goals and the transition to sustainable transportation. In response to the U.S. tariffs, Canada has sought to mitigate the impact by forging a new electric vehicle trade agreement with the European Union. This strategic move aims to diversify Canada's automotive partnerships and reduce reliance on the U.S. market. While this opens new avenues for Canadian manufacturers, it also intensifies competition in the global automotive market, potentially reshaping trade dynamics and alliances. While the European Union doesn't impose high tariffs on Canadian electric vehicles, making it an attractive alternative to the U.S. market, shifting focus to Europe comes with its own set of challenges. Canada already has a strong trade relationship with the EU under the Comprehensive Economic and Trade Agreement, CETA, which has boosted exports by 30% and facilitated the shipment of over 1 million tons of steel to Europe, aligning with the EU's demand for low-carbon green steel and critical minerals like lithium, cobalt, and nickel for its EV boom. However, one of the biggest hurdles remains logistics. Shipping vehicles across the Atlantic takes weeks, compared to the relatively short hours it takes to transport them to the United States. This means longer lead times, higher transportation costs, and potential delays in getting EVs to customers. Then, there's the issue of regulatory differences. Vehicles and parts designed for the North American market may need modifications to comply with European standards. Everything from emissions and safety regulations to charging port compatibility and software requirements could require adjustments, adding to production costs and slowing down market entry. Another challenge is competition. Unlike the US, where Canadian automakers have established relationships and supply chains, the EU already has strong domestic auto and metal industries, particularly in Germany, France, and Sweden. These countries have long-standing EV manufacturers and well-developed supply networks, making it difficult for Canadian companies to carve out a share of the market. Canada's situation is also different from countries like Japan and South Korea. While those nations have successfully sold vehicles worldwide, their entry into foreign markets wasn't just about overcoming financial barriers. They had to navigate complex trade relationships, brand trust, and even consumer preferences that took decades to develop. For Canada, the challenge isn't just about avoiding U.S. tariffs. It's about whether its EV industry can realistically compete in a highly established and well-protected European market. Trade disputes between major economies are nothing new, and history has shown that they often lead to economic consequences for both sides before reaching a resolution. One of the most relevant examples is the 2018 U.S.-Canada steel tariff conflict under the Trump administration. In an effort to protect American steel and aluminum producers, the U.S. imposed heavy tariffs on imports, including those from Canada. In response, Canada retaliated with its own tariffs on a range of American goods, including steel, aluminum, and various consumer products. However, despite the heated rhetoric and economic strain, the dispute did not last indefinitely. After months of negotiations and mounting pressure from industries affected by the tariffs, both sides agreed to a compromise, and the tariffs were lifted in 2019. This pattern has played out in trade conflicts time and time again. Initial economic disruption followed by a negotiated settlement once the costs become too high to ignore. Canada's response to the U.S. EV tariff follows this familiar pattern. By seeking alternative trade partners, such as the European Union, Canada is signaling that it won't simply absorb the economic hit without taking countermeasures. Whether this leads to another round of negotiations or a prolonged shift in trade relations remains to be seen, but history suggests that economic pressure often forces countries to find a middle ground. Some analysts believe this is a temporary move designed to pressure the U.S. into reconsidering its position. By signaling a willingness to deepen trade ties with the European Union, Canada could be forcing the U.S. to acknowledge the potential economic fallout of its aggressive tariff policies. Relying too heavily on the U.S. has left Canada vulnerable to sudden policy shifts, as seen in past disputes over steel, aluminum, and now EVs. Strengthening trade relations with Europe could provide long-term economic stability, reducing Canada's dependence on a single major trading partner. If Canada successfully integrates into the European market, it could emerge with greater leverage in future trade negotiations, not just with the U.S., but on the global stage. Whether this turns into a short-term trade battle or a long-term transformation remains to be seen. But one thing is clear: Canada's response to these tariffs could have lasting consequences, not just for its EV industry, but for the future of North American trade as a whole.